Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-Mini, the 10-year T-note market, the US dollar index, and the gold markets for Friday, February 10th. Starting off here with an intraday 4-hourly chart of the March S&P contract, and as we've discussed in some of our recent updates, you can see the market eroding overnight somewhat as a result of what seems to be a snag in the resolution of the debt Greek crisis, and it highlights the importance of Tuesday's 1331 corrective low that we have defined as a short-term but objective risk parameter. The market is now required to break to confirm a bearish divergence in momentum and define yesterday's 1353 high as one of developing importance, at least the end of the rally from the 1296 low from back on January 30th, and quite possibly the start of a much larger degree correction or reversal lower. So for shorter term traders with tighter risk profiles, a break below 1331 would require defensive measures for sure. From a longer term perspective, looking at a daily chart, such a shorter term momentum failure below 1331 would be grossly insufficient to confirm a larger degree high and a larger degree correction or reversal lower, and on that count, that 1296 corrective low from January 30th remains the level this market needs to break on a longer term scale to expose a much larger degree correction or reversal lower. Now, from a very long term perspective, and why we must pay particular attention to even short-term weakness like a failure below 1331. This weekly log scale chart shows the market's close proximity to the extreme upper recesses of the past year's range, defined by last May's 1373 high, amidst some of the most bullish sentiment accorded this market since that accompanied last year's major highs. Even at a 66% level, it is higher than, certainly in the same neighborhood as that accompanied the major peak and reversal last year. We had a 67% reading back in February. That wasn't the ultimate peak last year, but led to a 7% sharp correction ahead of a resumption of that bull trend and ultimate peak. So the market is arguably in a very precarious position way up at these levels, and we don't want to ignore even a short-term momentum failure that could morph into a much larger degree correction or reversal lower, certainly given tensions in Greece, Syria, and Iran and Israel. All these issues considered, shorter-term traders with tighter risk profiles, or basically anyone of a risk profile who cannot risk a larger degree down to 1296, is advised to move to a neutral sideline position, perhaps even a cautiously bearish position on the immediate break below 1331, with subsequent strength above 1353 required to mitigate that peak and reversal threat and reinstate the broader bull trend. From a longer term perspective, a break below the January 30th low at 1296 remains required to really confirm a major bearish divergence in momentum, and something that we think would expose a much larger degree correction or reversal lower. Pressure on the equity markets, and certainly any kind of international tension, is typically causes some type of quality flight to the 10-year T-note market and the US dollar index. And indeed, looking here at a 4-hourly chart of the March 10-year contract, you can see overnight's sharp, impressive recovery above the 131.07 corrective high from Wednesday. That absolutely confirms a bullish divergence in momentum and defines yesterday's 130.18 low as the end of this recent relapse from the all-time high at 132.11, exposing at least an interim correction of that sell-off and quite possibly a resumption of the secular bull trend. As a direct result of this bullish divergence in momentum, the market has defined yesterday's 130.18 low as a key short-term risk parameter. The market is now required to break to resurrect a broader peak and reversal threat. Until or unless such weakness is shown, we anticipate at least a steeper correction of this the late Jan, early February decline, and quite possibly a resumption of the secular bull trend, as on a broader daily scale shown here. You can see the very realistic prospect that, as sharp and as impulsive as the recent sell-off has been, it could certainly be just merely another corrective setback within the secular bull trend to new all-time highs above 132.11. And in this longer-term regard, the 129.26 low from January 23rd remains this market's perhaps its single most important technical level. as that's the corrective low. This market needs to fail below to confirm a bearish divergence in momentum of a scale sufficient to threaten the major bull trend, the secular bull trend, and expose a much larger degree of reversal lower. Until or unless such weakness is shown, and in this regard, minimally weakness below yesterday's 130.18 low, traders cannot ignore the possibility of a resumption of the secular bull trend and new highs above 132.11. These issues considered, long-term traders remain advised to maintain a bullish policy towards this market with weakness below at least 130.18 and preferably 129.26 required to defer or threaten that view. From a shorter-term perspective, at least an interim corrective recovery is required or is anticipated, with weakness below 130.18 now required to mitigate this view and reestablish at least the intermediate-term trend is down. Shorter-term traders with tighter risk profiles are advised to move back to a neutral sideline position, and we need a confirmed bearish divergence in momentum to stem this recovery and define a more objective high from which a resumed bearish policy can be more objectively based. You can see the market has thus far retraced exactly 50% of the recent slide, but there's been no bearish divergence in momentum to lend any credence to this merely derived Fibonacci level, and per such, further and possibly accelerated gains should not surprise. Moving to the US dollar index on an intraday 4-hourly chart, we continue to remind traders of the importance of the 79.52 corrective high from this past Monday. And you can see overnight's recovery, the market's failure to sustain recent losses below prior support from 78.62 and 78.77 that we would anticipate to be new resistance if the market was still weak down here at significantly lower levels than they were at the highs back in January. And it really highlights that 79.52 high, the break above which will confirm a bullish divergence in daily momentum. On a daily close-only basis, we think the key high is the 79.27 corrective high close from January 31st. A break above that will or a break above 79.52 on an intraday basis will confirm a bullish divergence in momentum that will, in fact, stem the decline from that 81.53 high back in mid-January and define the recent 78.52 corrective low close from February 7th as one of developing importance, and quite possibly the start of the resumption of the major bull trend that this market has experienced since May of last year. And it could be interesting to point out that in addition to the international threats from Syria and Iran, Israel, and the deep Greek debt crisis that certainly seems to have a cause and effect with a strengthening of the U.S. dollar. But there's also the inverse correlation between the direction, typically inverse correlation between the U.S. direction of the U.S. dollar index and that of commodity prices globally. And for most of last year, looking here at a weekly log close-only chart of the CRB Index, the actual cash index, that traced out a textbook 5-wave Elliott wave sequence as a result of the bullish divergence in momentum from late December, early January. You can see what we believe is a corrective recovery in commodity prices that has certainly seen a nice bid to commodity prices overall over the past month or so. But this chart also shows the very quick return to the upper recesses of the major down channel that's been in place since last April's high, and also very near the 38.2% retrace of the entire April through December decline that cuts across at 598.30. Our recent high weekly close is at 595.83. Zooming into a daily close-only chart of the CRB Index, you can see the slower rate of ascent over the past couple of weeks that has created the potential for a bearish divergence in momentum that, if confirmed, would contribute to a returning bid to the U.S. dollar index, we believe. Here you can see the typically inverse correlation between the CRB index and the U.S. dollar index. But on this scale, given the extent of this market's recovery and its sustaining thus far of gains above the previous 585.12 spot 12 high from back in early January, we feel a failure below that 585, the figure area, is required to confirm this bearish divergence in momentum that likely, we believe, will be accompanied by a confirmed bullish divergence divergence in momentum in the US dollar index above 79.27. These issues considered, traders are still advised to maintain a generally bearish approach, perhaps a more conservative one, paired to a more conservative level in the US dollar index, but strength above 79.52 on an intraday basis or above 79.27 on a daily close basis is sufficient to confirm a bullish divergence in momentum in the US dollar index that will define a more objective low and support at the 78.52 low close from February 7th and expose at least a steeper correction of the Jan-Feb decline and quite possibly a resumption of the broader bull move from the 2011 lows. Finally, given the inverse correlation between the US dollar index and the gold market and the fairly and generally positive correlation between gold prices and those of commodity prices at large, one would think that pressure on commodity prices and a bid to the US dollar index would put pressure on the price of gold. And indeed, you can see the relapse yesterday and overnight in the price of gold that we believe defines the 1755.5 high from yesterday as the B or second wave retest of last week's 1765 spot 90 high and the resumption of at least an interim correction and quite possibly a more significant reversal of the January, very impressive rally during the course of January in gold prices. We anticipate a break below the 1712 spot 60 low from this past Tuesday, exposing that C or third wave down of a larger degree correction reversal lower and defining that 1755 spot 50 high as a tight but objective risk parameter for shorter term traders with tighter risk profiles. From a longer term perspective, looking here at a daily log scale chart, we advise longer term traders to move to a neutral sideline position if the market breaks that 1712 spot 60 high in order to circumvent the depths unknown of a larger degree correction or reversal lower. From a very long-term perspective, looking at a weekly log close-only chart here, we continue to believe that the August through December sell-off last year is a major bull market correction that ultimately will provide, will re-expose the secular bull trend to another round of new all-time highs. But given these short to intermediate term developing threats to this market, a break below 1712 spot 60 we believe will expose a correction of the January rally, and frankly there's just no way to know the extent of that correction, so traders, even longer term traders, are advised to circumvent the risk of that and move to a neutral sideline position if the market breaks below that 1712 spot 60 low. Please stay tuned to updates on these and other markets on our rjomrt.com website.